Let's talk about a really important area called audit risk. Now, what was audit risk? I mentioned earlier. Audit risk is the risk that the auditor gives the wrong opinion. You give a clean, unmodified opinion on dirty numbers. Ooh, that's the scary risk. Why you toss and turn, you can't sleep at night. What is it? Audit risk. Now, audit risk, look at your notes, the risk that the auditor may unknowingly fail to appropriately modify the opinion on financial statements that are materially misstated. So it's the risk that material errors, frauds, or acts of non-compliance with applicable laws and regulations, called illegal acts, may cause the financial statements to be materially misstated, and that the auditor will not detect or properly understand them, resulting in the issuance of an inappropriate report. So that's what we're concerned with. That's called audit risk. So let's start over here with audit risk. Now, audit risk is the risk, again, that errors versus fraud exist in the financial statements. Errors versus fraud. That is called audit risk. So again, it's the risk that you give an unmodified, clean opinion on numbers that shouldn't be clean. Now, with audit risk, it is made up of three elements. And I mentioned them earlier, called inherent risk, called IR, control risk, called CR, and detection risk, called DR. Now, IR times CR times DR equals audit risk. So audit risk equals IR times CR times DR. And this is important. I'm going to introduce you to it now. We're going to do it again and again and again, and you're going to live it, love it, learn it. All right. So IR, CR, DR. Now, with audit risk, it's IR, CR. So it's the risk that you give the wrong opinion on materially misstated financial statements. IR, CR together is called your RMM, or your risk of material misstatement. The risk that you fail to, detect stuff that relates, or that you find the stuff that relates to the assertions in the financial statements. But I'll define it better in just a moment. So let's talk about IR, CR, DR. Inherent risk, I mentioned, was the risk inherent in any element, assuming no internal controls. My example was a whip out a $100 bill, leave it on the counter, come back in a month, it's gone. Tables and chairs, property, plant, and equipment, fixed assets have less inherent risk, so I don't necessarily have to bolt them down in order to make sure they don't disappear. But cash, you need to make sure you put in a lockbox. You need to make sure you put in a cash register that not everybody has access to. Otherwise, again, inherent risk. It is the risk that exists assuming no internal controls. That's called inherent risk. Let's look at our notes. The risk that a material misstatement of an assertion will take place in the absence of any internal controls. For example, cash is more susceptible to theft than property, plant, and equipment. Control risk is what? The risk that the client's internal control system, the way it's set up, will not prevent or detect and correct a problem. So if a mistake occurs here, based on the system, it'll flow through and end up where? Right here in the financial statements. That's called inherent. Let's read it. Control. The risk that the client's internal control structure will fail to prevent or detect and correct a material misstatement on a timely basis. This is a function of the effort put forth by the client's management to safeguard assets and ensure reliable financial records. We're going to break that one apart when I teach you about internal control. What is risk of material misstatement? It is IR and CR together is RMM, risk of material misstatement. Let's look at the definition. It says, it is the risk that relevant assertions related to the account balances, classes of transactions, or disclosures contain misstatements that could be material to the financial statements when aggregated with other misstatements. It consists of IR and CR. All right, so it's the risk that relevant assertions related to balances, transactions, and also disclosures contain misstatements that can be material to the statements. So what that means is, and I'm going to break that down in detail, I'm going to define for you what account balances, transactions, disclosures are. We'll deal with that even more when I teach you substantive testing. What is detection risk? Detection risk is you, the auditor, the risk that you, the auditor, do not detect the error either while you're doing internal control testing or while you're doing substantive testing. So, what is detection risk? The risk that the audit procedures will incorrectly lead to a conclusion that a material misstatement does not exist in an account balance when in fact such a misstatement does exist. So that's what we're looking at as far as those three. Now, as far as detection risk consists of two types of risk, TD and AP. What is TD? Test of details risk. What is AP? Analytical procedures risk. So test of details, and again, I'm going to teach this to you later, and I keep saying that because auditing builds. In other words, this is the one section where the first section leads to the second, to the third, to the fourth. By the time we get to the end, you go, now I see the whole picture. Whereas intermediate, financial, for the FAR exam, it doesn't really matter what order you go in. I try to teach it in a way so we kind of make sense and it flows nicely. But if you did section 1, then section 7, then section 2, then in FAR, it wouldn't make as much of a difference. Here, we have to start. Little baby step. Remember baby step? Remember What About Bob? Bill Murray, old movie. What About Bob? Baby steps. So we're going to baby step through planning the audit. Then we're going to look at all the different ethics and professional responsibilities. Then we're going to jump into things like internal control. Then we're going to talk about statistical sampling. Then we're going to talk about audit reports. Then we're going to go through reviews and compilations, SSARS. Then we're going to go through special stuff, other stuff, governmental stuff, forecast projections, comfort letters. Then we're going to go through IT, and then we're going to be done. Wow. Can't believe it. It's so much fun. We have so many fun-filled hours ahead of us. I am jealous of you. All right. So, what is test of details? That's the test of the detail of the account, the balance, the transaction. What are analytical procedures? Study of data comparisons and relationships. So it is the risk that you don't detect it while you're doing this kind of stuff. That's called detection risk. If you look in your notes, you'll see audit risk is IR times CR times DR. Now, this is important. Let's solve for DR. In bringing that, so remember your math, you divide that, bring it over. So now I end up with audit risk over IR times CR equals DR. This is an important formula, and here's why. Of all of these risks, the only risk that you, the auditor, can control is what? Detection risk. Because audit risk is a combination of IR, CR, DR. Inherent risk is the risk inherent in an element, assuming no controls. You can't control that. Control risk is the risk that the client's internal control system will not prevent or detect and correct. You have no control over that. We're going to test it, but we have no control. The only one we control is detection risk. Because if I want to make sure that if there's a problem, I detect it, I better do more work. If I'm willing to let my detection risk go up, then I can do less work. So, in solving for this, in looking at the formula, again, as we look at this, if, let's say, and let me kind of break it down a little easier, let's say reliance on internal control is low. So I say, hey, do we have these controls? No. That means my control risk is high or at the maximum. What is control risk? The risk that the internal controls will not prevent or detect it. If the risk is high that it will not prevent or detect it, there's a lot of risk. So therefore, if I define, let's say I define my audit risk at a number, 6%. That's what I'm willing to accept, audit risk. So if numerator down denominator, if this number goes up, what happens to the whole fraction? Let's see. What's 2 over 2? 1. What's 2 over 4? A half. So if this number gets bigger, the fraction gets smaller. This gets smaller. There's your inverse relationship. Oh. So if control risk goes up, detection risk goes down. So if I want this number to be the same, I want this to be a certain number. If this goes up, this has to go down to equal the same number. Make sense? So here's the deal. If reliance is low, that means I don't think internal controls are good. That means control risk is high. Since control risk is high, I want my acceptable level of detection risk to be low. How do I get it low? By doing more substantive testing. So there is an inverse relationship between reliance and substantive testing. Again, just to refresh your memory, what is reliance or internal control test? That's where you're testing, is it signed? Is it dated? Is it canceled? Is the control being adhered to? What is substantive? That's where you're substantiating, corroborating the dollar amounts. So if reliance is low, I better test more of accounts receivable. If reliance is high, let's do the inverse. If reliance is high, that means control risk is low. Since it's low, I'm I'm willing to let my acceptable level go up. Remember, the only risk you control, detection risk. I'm willing to let that go up. Why will it go up? Because I'll do less testing. Why am I going to do less testing? Because I can rely. So it flows in this direction. Reliance is low, this is high, this is low, boom. This is high, this is low, this goes up, I'm willing to do less work. Now, how do we do more or less work? You do more or less work based on what? Materiality. So, for example, here was 0, here's 100%, here's materiality. This is the scope of my audit. If reliance is low, that means what? Control risk is high. That means what? I want my acceptable level. The only risk I control is detection risk. How do I control it? By doing more work. How do I do more work? By dropping materiality that will increase the scope of my work. I'm going to do more scope, more substantive testing. Oh, so that's it shows up on every exam, right? I guarantee it on her life. I'm just kidding. So make sure you understand it. This is an important concept. Now, backing up again, what is audit risk? It is IR times CR times DR, or audit risk divided by these two. Now, what was IR and CR together called? Risk of material misstatement, right? That relates to financial statement assertions. So so you could see it on the exam as RMM. They still quite often use CR versus DR. So either way is fine, but I just want you to understand that. I want you to understand what is audit risk? The risk you give the wrong opinion on the statements. Why? Because of errors and fraud, which we're going to define in just a few minutes. What are errors and fraud? Now, in the notes I said, and I gave you an example, first of all, the auditor performs the following procedures. What are they? First, look at the bullet there. It says, determine the acceptable level of audit risk. That is the risk the auditor is willing to take, incorporating cost and benefit considerations, that a material misstatement may not be detected. Assess the risk of material misstatement, which is IRCR. Then determine the level of detection risk necessary to achieve the desired audit risk. All right, for example, let's say your acceptable audit risk is 6%. Okay, 6%. Then it says, let's say your inherent risk is 80%. So it says here your inherent risk is 80%. And that means that that is a high risk, right? Assume 80% indicating that a material misstatement does occur. There's an 80% probability that it will never be prevented or detected and corrected on a timely basis. Control risk, assume that is 75%. Control risk. Assume a value 75%, saying that the probability that financial statements will be materially misstated if internal controls do not prevent or detect the misstatement and if the auditor does not detect it. Therefore, my RMM is what? My risk of material misstatement is 3/4 of 80, which is 60%. So therefore, audit risk equals IR times CR times DR. Or audit risk divided by IR times CR equals DR. So in solving for that, we end up with what? We end up with our detection risk is 10%. So therefore, if this goes up, this goes down, right? We need that to go down. If this goes down, we're willing to let that go up. Why would your detection risk go up or down? That affects how much work you're going to be doing. So you'll see that example in your notes. Again, you can kind of look through it, kind of work through it, kind of understand it in order to see how all of those things are interrelated and how all of these things tie together. That is, again, how all of these tie together, how all of these fit in. Now, what does that mean? Again, what it means is that we're looking at our audit risk and the elements of our audit risk. So in looking at your audit risk and the elements of audit risk, what we need to do is make sure that we understand how they all tie together. Now, in looking in your notes, it then talks about fraud and errors. So as I said, audit risk, the risk that fraud and errors exist. So let's talk about fraud and errors. Now, what's the big difference? Well, errors would be unintentional. 2 + 2 is 5. It deals with competency of the employee. Fraud is generally intentional. It deals with the integrity of either the management or integrity of the employees. Because you might have fraud at a low level where you've got an employee stealing stuff out of the factory. You may have fraud at a high level where upper management is changing information so that they meet analyst estimates on these numbers. Because we all know earnings reports, right? Every quarter they come out, every year they come out. And based on the estimates, the stock price goes whoop or whoop. So if you have that information, it affects your investments and everything else. So it's important to understand that we need to know what's going to happen. So if for some reason management is not going to make those estimate numbers, what happens? Analysts' estimates say, well, we expect Facebook to have a profit of 3 cents a share. And it comes out to 3.5 cents a share, boom, stock goes up. Comes out to 2.5, boom, stock plummets. So what might management do? They might fudge the numbers a little bit, cook the books a little bit in order to meet the numbers so the stock doesn't plummet, because they have stock options, they have a vested interest, they're management, they are employees, they have stock options and so on. So that's why they're concerned with it. So that's what we have to look for. Looking in your notes, fraud and errors, AUC 240. Says the auditor's responsibility is to plan and perform the audit to obtain reasonable assurance that no errors or acts of fraud have caused the financial statements to be materially misstated. Now, what is a misstatement? A misstatement is a difference between the amount, classification, or presentation of reported information, the omission of a financial statement element, account, or item, a financial statement disclosure that is not presented in accordance with the standards, the omission of information required to be disclosed. So all of these would be what we call a misstatement. And again, that's what we're looking for, materially misstatements. The use of estimates in accounting increases the risk of material misstatements because estimates require the application of judgment. They're subject to human error. They are susceptible to manipulation. The auditor generally examines samples as a basis for drawing conclusions about a population. Misstatements that are detected in a sample often indicate that comparable misstatements may be presented proportionally within the population, implying a greater misstatement of the population. One of the things we'll talk about in audit sampling, we're going to take a sample of the entire population. Based on that sample, we're going to take that and extrapolate it out to the entire population and come up with an audit adjustment. We'll talk about that with classical variable sampling, with PPS dollar unit sampling, probability proportional to size, and so on. So we'll talk about how it affects it. I'll also compare and contrast that in one of the sections where I talk about international standards in auditing, or international auditing standards. Basically, they talk about an anomaly. Well, if it doesn't work, then they think, oh, it's an anomaly. This one exception came up. We'll make an adjustment for that one exception. They don't expand it to the entire population. U.S. GAAP, right, says basically you need to take that and expand it to the entire population. Material misstatements can result from errors, meaning unintentional mistakes, or fraud, meaning intentional misbehavior. Both could be known or likely. So we're going to have to define known and likely in just a moment. Errors, unintentional mistakes, misjudgments, omissions of amounts or disclosures may be due to human error or incompetency. So you can see we're concerned with errors. Why? Because these numbers may not be correct because of the errors. But it was an accident. You're just not that smart. Okay? So you made a mistake. Okay, but we're still concerned because it affects our opinion. With fraud, because it deals with integrity, we're really concerned. So there are two different types of fraud. One is called fraudulent financial reporting. The other is called misappropriation of assets. Okay, so we have fraudulent financial reporting, misappropriation. What is the difference? These are two types of fraud. Now, fraudulent financial reporting is at a higher level. That's where upper management as a whole, or at least some individuals at the top, what are they doing? They're fraudulently reporting the financial information in order to meet the industry analysts' expectations. They're cooking the book, so to speak. So in your notes it says here, this deals with integrity. What are some examples of fraudulent financial reporting? Manipulation, falsification, alteration of accounting records or supporting documents, inability to produce or locate relevant documents may also be indicative of fraud. Misrepresentation or omission of events, transactions, or information, intentional misapplication of accounting principles, the non-recording of transactions. They're not recording certain things. What is misappropriation of assets? That is called, in yellow in this word, defalcation scheme. They've used that. What is a defalcation scheme? That could be fraud, embezzlement. It says here, embezzlement of funds, theft of assets like stealing, misuse of entities' assets, So this would be like your employee is ripping you off. How do you fix that? You pull a Trump. That's his hair, by the way. You're fired, right? My hair goes. So that's how you get rid of it. Fraudulent financial reporting is happening at a higher level. Therefore, it affects more of a wide range of areas in the financial statements. It says the auditor evaluates the two types of misstatements resulting from errors and fraud. They are known or likely. Known means they are known, they've been identified. Likely means, well, they're likely to exist. What is our job? It says the auditor must communicate all known and likely misstatements, even immaterial, identified during the audit, other than those the auditor believes are trivial, to the appropriate level of management on a timely basis. That's what we have to do. Management must correct all known misstatements and should evaluate items for which they are likely. All right. It says, although the auditor cannot ultimately be held responsible for detection of fraud, the auditor is expected to recognize the possibility that it may occur, and it may result in a material misstatement of the statements. In planning the audit to consider fraud, the auditor will consider 3 conditions that are generally assumed to be present whenever a successful fraud occurs. So these are 3 conditions that exist whenever a fraud occurs. In other words, we've got reason or motivation. Motivation. We have opportunity and rationalization. So we've got motivation, opportunity, rationalization. So motivation, opportunity, and rationalization. So motivation means that there's motivation. There's a reason to do this. What is the reason to do this? It's either incentive or pressure. What is the incentive? The incentive is, I'm going to commit this fraud. Why? Because I'm going to make a lot of money. I'm incentivized. Yeah. Or there's pressure. If we don't meet those numbers, you're going to lose your job. That's a lot of pressure. So now I'm motivated to commit a fraud. There's the opportunity. The opportunity means there's a lack of internal controls. And we'll talk about that in the internal control section. But it basically says, and I'm going to teach you this memory aid or mnemonic that's going to be really important for the exam and in your entire life. Noah and the arks. What does that mean? These are things that should be done by different people. You don't have to write it down now. It'll be in your book when we hit it and when we need it. But A is authorization, R, recording, C is custody of assets, and C is comparison. S stands for segregation. The person that does this should not do this, should not do this, should not do this. Imagine, I have the authority to authorize a purchase. I then have custody of the check, so I sign the check. I then do the bank reconciliation at the end of the month. So I could basically buy anything and then reconcile it. So that is fraud. In other words, if you have one person that can do all these things, that is a bad internal control system. That's a bad segregation of duties. So when we talk about your control risk, about internal control, it's going to be really high. So this is a problem. So that's what's happening there. And then finally, rationalization is an attitude to rationalize it. What kind of things would you rationalize? Well, it's kind of like this. You go to the store and you get the wrong change. You go to Walmart and you go, those owners of Walmart are all billionaires. Every kid, I forgot, there's 3 kids or 5 kids, they're all billionaires. And, they underpay their people. They don't let their people join unions, blah, blah, blah. They gave me $20 in extra change. You know what? I deserve it. You rationalize it, right? Little Roger, CP review. Oh, we accidentally sent me 2 sets of books. Guess what? You're going to be nice. You'll send them back. Okay, thank you. But the point is rationalization. Basically, it's our way to rationalize it. So when you look at the fraud risk triangle, you'll see here that in this triangle, you've got motivation, opportunity, rationalization. Again, that is, present whenever this fraud occurs. There's also something called non-compliance with applicable laws and regulations. So I'm going to put here non-compliance with laws and regulations. Basically, illegal acts. And we used to call this illegal acts. Under the Clarity Project, it changed it to be more clear. Instead of illegal acts, it says non-compliance with laws and regulations. Now, it may be intentional, it may be unintentional. I'm still going to kind of throw it under the fraud area. As far as non-compliance with applicable laws and regulations, it says we need to distinguish between those that have a direct effect on the numbers and those that have an indirect effect. Illegal acts with a direct effect may include non-payment of payroll taxes or business licenses. That affects your numbers. Illegal acts with an indirect effect may be antitrust violations or price fixing or things dealing with OSHA, Occupational Safety and Health Administration. So maybe, for example, you don't have a sign in the bathroom that says lávese sus manos. What does that mean? Wash your hands. That's illegal. It's a violation of OSHA. But does it affect the numbers? Not really. So that might be an indirect effect. It says the auditor's responsibility is to consider laws and regulations that have both a direct effect and those that do not have a direct effect or an indirect effect on the financial statements. The auditor should communicate with those charged with governance matters involving noncompliance other than those inconsequential matters as soon as practical. The documentation should include a description of the identified or suspected noncompliance and the results of the discussion with management and those charged with governance and other parties inside or outside the entity. Also, increased emphasis on professional skepticism. So, again, quick review. What is it? What is audit risk? Audit risk is a risk that errors or fraud exist in the financial statements. What is audit risk? Audit risk is a risk that you give a clean opinion on dirty numbers. You give an unqualified, unmodified opinion on numbers that should be other than unmodified. That's audit risk. What does audit risk consist of? IR, CR, DR. Audit risk is this times this times this. Inherent risk is the risk inherent in any element, assuming no controls. Control risk is the risk that the internal controls will not prevent or detect it and correct it. Detection risk, the risk that you, the auditor, will not detect it while you're doing your test of details risk, TD, or your analytical procedures. What is the formula? Audit risk is IR times CR times DR. Solving for DR, what do? Audit risk over IR this times CR. Remember, these two are RMM, risk of material misstatement. Inverse relationship. As this goes up, this goes down, and vice versa. How does that relate? As we said earlier, if reliance is low, control risk goes up. We want this low. This is the only one you control. How? By doing more or less work, by adjusting materiality. That's how you, the auditor, control detection risk. We can control. It's the only one we control by doing more or less, by increasing or decreasing materiality. What are errors? Unintentional, deal with competency. What is fraud? Intentional, deal with integrity. What is fraud? Two types: fraudulent financial reporting, misappropriation of assets. Fraudulent financial reporting, higher level, misappropriation of assets. Another type of issue used to be called illegal acts. Now it's called non-compliance with laws and regulations. We are concerned with those that have a direct and material effect and those that have an indirect effect if it affects the financial statements. So those that affect the financial statements, those are the ones that we need to communicate to the company.